With the Canadian Pacific and Kansas Southern deal now complete, it is time to deep dive back into this new North American mega line. Before we take a ride on the Canadian Pacific Kansas City Rail, be sure to collect $200 if you pass go. Investing in the Canadian railroad industry can be seen as a strategic move for those seeking a solid, recession-proof investment. This sector forms the backbone of our country's robust trade and commerce system, facilitating the move of goods across, well, very vast distances, irrespective of economic fluctuations. In fact, transporting goods via rail is still the cheapest and most economic way to move most items. There is a constant demand for transportation of essential commodities such as food, energy, and raw materials. And this, as well as that economic factor, that helps to insulate the industry from economic downturns. Moreover, the recent CPKC merger has further fortified its market position, demonstrating potential for significant growth and, of course, stability. The Canadian Railroad thus stands as a resilient investment choice, even during challenging economic times. CNR has always been a no-brainer when it comes to investing in railroads, but it's hard to ignore CP now with this merger. Founded in 1881, the Canadian Pacific Railway has been instrumental in shaping Canada's history and, of course, our development. Built to fulfill a promise made during Confederation, the CP Rail connected Canada's coast, fostering settlement, trade, and, well, economic growth. The railway was a monumental feat of engineering, traversing mountains, forests, and prairies. It was completed in 1885, which was actually 6 years ahead of schedule, and it has forever changed the landscape of our country. Fast forward to the 21st century, CP Rail expanded its reach well beyond Canadian borders. In March of 2021, CP Rail announced plans to merge with the Kansas City Southern Railway, creating the first rail network to span the United States, Mexico, and Canada. This merger promised to revolutionize North American rail transport, providing single-line services and enhancing competition in the rail industry. It is seen as a significant move, and it does promise a lot of growth and some increased market share. There were certainly hurdles to overcome with various regulatory bodies. Despite those hurdles, the merger became official on April 14th, 2023. CP has since changed their name to CPKC, but they are continuing to trade on the TSX as well as the New York Stock Exchange using the ticker of CP. Join the conversation. Let us know in the comments if you hold any CP stock. Your participation is, of course, well appreciated. Don't forget to like and subscribe to stay up to date on future content, and thank you for that. Click. One of the most interesting ramifications of the new Canadian Pacific Kansas City Rail is that access to Mexico. I can absolutely say if I wanted to ship something from Canada to Mexico, why would I use multiple railroads when I can just use one? This really is setting CPKC Rail up for some solid growth, and it may very well be absolutely great growth for investors too. However, as good as it sounds, we need to pay a visit to our friend Mr. Math for the true, of course, numerical skinny on this stock. When we start with some surface data, their market cap comes in at $77.22 billion, and they've got a rather stable beta of 0.83. Their earnings per share, that comes in at 2.99. Now, when we switch over to price to earnings ratio, it does come in a little high at 27.74. The average amongst their peers is 16.1. However, one good way to inflate your PE ratio is to merge with another company. So the fact this is higher needs to be taken with, well, a grain of salt. If we look at their price to book ratio, it comes in at 2.60. The average in their peer group is 6.0. This alone kind of proves what I was saying about their PE ratio, taking it with a grain of salt. Let's take a look at their cash flow. They have a revenue of $9.24 billion, and their earnings come in at $3.73 billion. Now, with those earnings are projected to grow by 11.35% per year over the next 5 years. In fact, last year, those same earnings grew by 31.2%. That's not too shabby. Free cash flow, they've got $2.67 billion, which is great. Let's look at their return on equity. That comes in at 10.14%. That's not too bad. All right, let's talk a little bit about their fair value. Their current value is $111.04. If we look at a discount cash flow model, we get a fair value of $93.26. That would imply that they're overvalued by 19.1%. Once again, as the merger settles, we will see things change, and I expect this number will moderate a lot in the process. So once again, this is a value I'm kind of taking with a little bit of a pinch there of salt. All right, let's switch over to their dividends. They do have a yield. It's not very big, but it is a 0.684%. So that's quarterly paid out in the form of 19 cents per share. This payout ratio works to 19%, so it's absolutely very sustainable. This is a dividend I would really like to see get boosted because it is on the low side. Let's look at their return on investment. 3 years ago, they started at $68 and they are now at $111.67. That gives us a return on investment of 64.22%. Add in those meager dividends, we get a total return of 66.77%. That's not too bad. If we switch over to 1 year, so in the last year, they've gone from $87.96 to, well, that $111.67. That is a return of investment of 26.96%. Add in the dividend, we get a total return of 27.60%. That is really good considering we were in a bear market. We more than overperformed the TSX by a long shot. So far in 2023, their price has risen from $102.13 to $111.67. That is a return on investment of 9.34%, total return of 9.48% after we factor in those dividends. So growth-wise, this is a fantastic looking company. They have been doing well, and that is that whole recession-proof part of railroads, especially the Canadian railroads that I've been talking about. Let's look at their debt. Their total debt comes in at $19.16 billion, but they do get a lot of equity. They got a total equity of $39.52 billion. This makes their debt to equity ratio 48.5%. CP does have a good amount of debt, but despite that, their debt to equity ratio has been decreasing, which is always a good sign. In fact, 5 years ago, they had a debt to equity ratio of 130.4%. Their debt and interest on that debt is well covered by their operating cash flow, as well as their earnings before interest and tax, or EBIT. Let's take a look at the short term now. In the short term, they have short-term assets of $1.78 billion, and they've got short-term liabilities of $2.68 billion. This is definitely skewed towards liabilities, but once again, that is because of that merger. When we look at their long-term, their assets are $71.72 billion, and their liabilities are $31.30 billion. As I said before, short-term is not the best picture, and that can really be written off as a side effect of that merger. The long term shows a more accurate picture of what is going on with the stock, and it does reflect a healthier view on CP. Okay, so what of course is my final verdict? I love railroads, especially the Canadian ones. This stock has a lot of potential, and overall, I do think it is worth looking at if you are interested in diversifying into the transportation sector. The merger with Kansas City Southern is a bit of a double-edged sword in that it will maybe slow some of the potential growth in the short term, but it could absolutely be a fantastic catalyst for longer-term growth. CP has a good amount of debt, but it also has the equity to pull it off without concerning me too much. Sure, I would love to see it drop lower, and I think it will once this merger settles. This is a railway I do hold and will continue to hold and more than likely add to. It is recession-proof and maybe, just maybe, has an edge now on all the other railroads in North America. This is, in my opinion, a stock you really may want to do some due diligence with. Keep the learning going. Watch my video on Scotiabank linked on the left, or test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner. Be sure to also check out my trades and portfolio over on Blossom, linked below. See you in the next video.